Assalamu alaikum. Welcome to lecture 10 of ATX. So in my lecture 8 and 9, I've discussed how to calculate capital gain tax, stamp duty, land tax. Now we'll be moving on to shares. So all the exempt assets, exempt disposal, taxable assets, taxable gain, how to calculate we have covered. In this lecture, we'll be focusing on shares and securities and also stamp duty. In my lecture 8, I have covered stamp duty, land tax. That is for land when you're buying. But stamp duty is just for the shares you have to pay. Okay. So here we are going to go through revision of basic shares and securities because this is from your taxation. It's not new. Reorganizations and takeover. Liquidation of a company. This is new for ATX. It's there. It is introduced in ATX. It was not there in your tax. Stamp duty and stamp duty reserve tax and summary. So let's start with the overview. We are going to go through the exempt assets, revision of basic CGT rules, valuation rules, how do you value shares, whether it's quoted, unquoted, identification rules, bonus issue and right issue. We have covered this in tax. You'll be very familiar with it. Then share reorganization and takeover. Okay. When we change share to debt, debt to share, and we take over with share for share exchange or partially share, fully share, what happens, what is the impact on tax, that we are going to cover. Okay, mixed consideration means we have both share and cash. Next, stamp duty on shares. That's a small part. So now, first we'll go through the exempt shares and securities. Listed government securities are exempt from CGT, like gilt age securities, treasury stock. Then we have QCB, qualifying corporate bond, example company loan stock, exempt. Shares held in an ISA, exempt. Note, gilt aged securities and QCB are exempt only when it is disposed by individual or a trust, but for the company it is not exempt. So when we go to the company, we'll be going through this once again, QCB. Okay, now what is QCB? A QCB is a loan note which represents a normal commercial loan. It's like a normal loan. Then it is expressed in sterling and has no provision for either conversion into or redemption into any other currency, and you cannot convert it into shares. Valuation rules for shares. Very important for the purpose of the rest of this lecture. Remember, the rules described apply to both shares and securities which are not exempt. Because if it is exempt, why should we know the ruling, right? Makes sense. However, for simplicity, in this case, shares will take both shares and securities. Wherever we say shares, that means it's applicable for both the shares and securities. Now, on the sale of the shares to an unconnected person, actual sale proceeds are used in the chargeable gain. And if it's a gift of shares or a transfer to connected person, we use the market value. This we have covered in my previous lecture, lecture number 9 also. What happens when we dispose not shares but other assets, qualifying assets to a connected person, to unconnected person. There also we went through the valuation rule. But that is apart from share. This ruling is for shares only. Do not confuse the two, okay? So now the market value for shares. If it's quoted shares, okay, you get the mid price. Whatever is the mid price, you get the highest and the lowest and the average of it. This you will get from the stock exchange. The prices you will get from the stock exchange because it's quoted shares. So the mid price, the mid means average of highest and lowest closing price. And if it's unquoted, in the examination, they will give you the value. So you don't have to worry. Now let us do a small question. Test your understanding 1. So here we have to find the value of ABC shares. Okay, you have been given the prices, highest and the lowest. So just find the midpoint of the two. That would be the price. That means add 270 plus 230 and divide by 2. It would be 250. So this is the price, 250 pence. Identification rules for individuals. Now, when we are disposing the shares, it is matched in the following order with accusation. You have to follow this order. You can't change the order. 1, 2, 3. Number 1, you have to match the disposal when we have purchased a share on the same day. Okay. Then you have to see whether you have any purchases made within the following 30 days. That also in FIFO basis, first in, first out. Next, from the share pool you have to take. Share pool means we pull together all the shares. Okay, the shares acquired, of course, before the date of disposal. Then, the share pool simply keeps a record of number of shares in the same company acquired and sold and the cost of those shares. When we are disposing the shares out of the share pool, remember the appropriate portion of the cost that relates to the share disposed, you have to calculate. And the shares are disposed at their average cost. Now, coming to bonus issue and right issue. We'll definitely do questions on this. So, bonus issue means you are distributing a free shares to existing shareholders and in proportion to existing shareholding. Right issue, it's an offer of new share and same to existing shareholder only in proportion to existing shareholding, but here you will be giving it at discount to the current market value. For identification, both bonus and right issues are included in the share pool. And for calculating the gain, bonus, since see bonus shares are free, that's why it will have no impact at cost, but number of shares, okay, it will have an impact in the number of shares but not the cost. And the total cost of the shares purchased is shared between all of the shares in issue after the bonus issue. We'll see, we'll do a calculation. And for right issue, because there's a cost involved, so number of share will be affected with cost as well. Even the cost will get impacted. Okay, that cost will be added in the pool as a normal purchase. Now, the total cost is shared between all of the shares in the issue after the right. That means when we are taking the total cost, that will be taken after you take bonus issue and right issue in that share pool. Now let's do question. So we have two questions. One is illustration 1, which is having both bonus and a right issue, and then we have test understanding 2. So first we'll finish illustration 1. Calculate chargeable gain or allowable loss. Okay, on the disposal. So remember, they will always follow the chronological order according to the dates. Okay, so purchased 1800 shares for 5400, bonus is 142, purchased 600 for 1500, then took up 1 for 3 right issue at 2.3 and then sold 4000 shares for 14,000. So we have to find the cost in the share pool because we have to deduct that from the sale proceed to get the gain or a loss. So let's quickly do that. And remember, it's on a, you have to follow the rule. First on the same date, then following 30 days, and then from the share pool. So first we'll see, when are we selling it? On this date. Are we purchasing anything on that date? No, nothing. Everything was purchased before. Then did we purchase anything following 30 days? No. That means everything has to be taken from the share pool, the last option. So now, to get the share pool, we have to take the number and all the cost. That means add all the shares. So let's quickly do that. Okay. So we'll take this one. This is a bonus. Then we'll take purchase. Then we'll take the right issue. Okay. So on one side, I'm going to write number. This is the number of share. Then cost. This you can very well do in Excel in your exam. Please write the dates. Very important. Dates are very important. Jan 20. The other purchase was, bonus issue was March 2021. Then May 2021 again we purchased. Then June 2021 there's a right issue. Then August 2023 a sale took place. So it's purchase, bonus issue, again purchase, right issue, and sale. Okay, so first we got 1800 shares, cost is 5400. Then what is the bonus? 1:2. So when we take the bonus, remember bonus will have no impact in the cost. Cost will be 0 for bonus. It will only have an impact in the number. So 1:2. That means for everyone they are giving 2 bonuses. So you have this share before that bonus. It's 1800 divided by 2. This is the ratio, 900. That means you'll be giving 2 900 shares as a bonus. 900 shares for 1. See, this is how it works. For 1:2. That means for every 1800 shares. Read the question. Bonus issue of 1 for 2. Of 1 for 2. That means you have to find this. So it's 1800 divided by 2 to find this. You'll give 1 bonus for every 2 shares that you have. This is the meaning of it. Do not get confused. Because most of the students often don't know whether to multiply or divide. They make this mistake. They go and start multiplying. Don't do this. Okay. Now, then they purchased 600. All is given here. Okay. 600. This much. Cost is given. 1500. Then to get the right issue, remember we already have some purchase and bonus before coming to the right issue. So we should know the number of the shares standing before the right issue. So we'll add all. It is 3300. The cost is 6900. Before coming to the cost, what is the right issue? 1:3. So we already have 3300. It's the same thing. 1:3. So 3300. To find this, it's 3300 divided by 3. So it's 1100. The right issue is 1100. That's what they have told. Right? Took up 1 for 3 right issue. They didn't say took up 3 for 1 right issue. If it was the other way around, then you would have multiplied by 3. So it's 1100. And remember, the cost. Right issue will have an impact on cost. It is issued at 2.3. So 1100 into 2.30. What is it? 2530. This 2530 you will add in the cost here. 2530. Now add everything before the sale take place. 4400, 9430. So you have sold 4000 shares. For how much? Sold 4000 shares for 14,000. Remember, you have to find the cost. Don't write 14,000 here. Don't write 14,000 here. 14,000 is sale proceed. This is cost column. We have to apportion for selling 4000 shares. What is the cost? This you will do how? Using this. So it's 4,400. Sorry, 4,000. You have sold out of 4,400 shares. What is the total cost? 9,430. Let's do it. It is 8573. It's always like this. Okay, always. So the cost is 8573. This has to be deducted. Then you will be having 400 and 857. This is balance carried forward. So now what is the sale proceed? 14,000. You have sold it for 14,000. What is this cost? This cost you have to find. This is the reason you have to do all this table to find that cost, because you have to deduct from the sale proceed. 8573. That means to sell 4,000 share, this much is the cost. 8573. And this is your chargeable gain. 5427. Chargeable gain. Coming to test understanding 2 is very easy. Keep practicing where you have to use share pool and all. Now, identify which shares are sold and calculate total taxable gain. So here you have been given the numbers. See, wherever they didn't say anything, okay, you have purchased. And wherever right issue and bonus issue are there, they will write like this. And it's not always compulsory that bonus issue has to be first and then right issue. It could be any order. Okay. Now, after this, she disposed this much and she sold it for 22,500. Same thing. On which date? 31st December 2023. What should you do first? What should you do first? Always follow the order. Don't straight away jump to the share pool. No. First check, are their shares acquired on the same date as this date? 31st December 2023. No. Nothing from the list. Then, shares acquired in the next 30 days. If you see next 30 days, it is this. Yes, you have acquired. From 31st December to 28th Jan. It falls within 30 days. How much? 1,500. So out of this 4,500, 1,500 is allocated here. That means the balance 3,000 shares you have to take from the share pool. Understood? 1,500 you will take 30 days. Next 30 days purchase. And the balance 3,000 you will take from the share pool. So now, what do you have to do? You have to find the cost. But remember one thing. For this 3,000 we have to work out. But what about this 1,500? For this we can find the cost. Why? How? Cost is already given here. 3,000. Isn't it? So let's do that. So there are two gains. Okay. Two gains you have to work. You will add the gains together. First one. Shares acquired 28th Jan 2024. How much? To find this, we'll use the proceeds. You don't have to do the table. What is the amount of the proceed? It is 22,500. Okay. Sorry, it is 22,500. Multiply it with, how much did you purchase? 1,500 from 4,500. This is to find the proceed. It is 7,500. Then from here you can straight away deduct 3,000. Why? Because for 1,500, 3,000 is the cost. This is the cost. This we did, this working we did to find this sale proceed. Because this 22,500 we can't use. Why? That 22,500 is for the full 4,500. But we have to allocate this. One to this 1,500. The other 3,000 will come from the share pool. What is the sale proceed? So we are finding the sale proceed if we are just selling 1,500 out of 4,500. That's why we allocated the proceed like this and got the proceed, and then minus the cost 3,000. Okay, which would be 4,500. Next, from the share pool, shares in the share pool, the balance. This two way you can do. One is 22,500, right? So 22,500, already you have taken the proceed for 1,500. That means when you are selling 1,500, sell proceed is 7,500. The balance, it would be 15,000. The other way you could do is like this. Both method you will get 15,000 only. What is it? Now you are using 3,000 from the share pool for 4,500 into what is the sale proceed? 2,500. So the sale proceed is 15,000. What is the amount? 3,000. No, you can't get the cost now. Why? You need the share pool. Now you need the share pool. So let's go to the share pool working. So here, this one is out. This one you will not include in the share pool. Only up to this much. So straight we'll do that. April 2000, June 2003, May 2012, July 2012, August 2016, and finally when you are selling, December 2023. So here we are purchasing. Here it's a right issue. Here again we are purchasing. Here it's a bonus issue. Then we are purchasing once again, and then we are selling. Okay, so right issue is 1:3, 70 pence, and 1:4 is for bonus. So next to it always write. It is 1:3 into 70 pence, and bonus is 1:4. Okay, then the number and the cost. So how much did we purchase? 1,500 and cost was 900. 1:3, so 1,500 divided by 3, right? Share 500 into 70 pence. It is 350. Then we'll add. Straight away we can write 1,000 we purchased. Cost was 2,000. Now add up before the bonus issue. So the total is 3,000. Cost is 3,250. 3,000 divided by 4, 750 is the bonus, no impact on cost. And purchase 900, 1,500. So the total value here will be, before sell is 4,650, 4,750. We are selling 3,000 now. 1,500 already went from the 30-day purchase. This we have to find out. It is very simple. 3,000 divided by 4,650 into 4,750. Divide, multiply. It's always like that. It would be 3,065. Okay, so this is the cost we are finding out. So that will deduct from 15,000 here. Okay, which is 11,935. Don't forget to add this too, which would give you a gain of 16,435. Don't forget to deduct annual exempt amount of 6,000. AEA. Then you will get 10,435. This is your chargeable gain. Okay, total taxable gain. Taxable means you have to deduct your, see, always see whether they asked you chargeable gain or taxable gain. If it's chargeable, if the question was chargeable, do not deduct your annual exempt amount. If it is taxable, then deduct annual exempt amount, because from chargeable gain, if you deduct annual exempt amount, what you get is taxable gain. You see, that's why we deduct a 6,000 of annual exempt amount. Next, sale of rights nil paid. This is new. If the shareholder who is offered a right issue, but they don't want to purchase more shares in the company, what can they do? They can sell that right to someone else to buy the new shares. Okay, they can sell the right to buy new shares to another person. That means they are selling their right. This is known as sale of rights nil paid. Now, how do you treat it? It depends on the amount of the sale proceed. If the sale proceed is greater than 5% of the value of the shares on which the rights are offered and greater than 3,000, and both has to be satisfied, Or condition means if one of them is satisfied, done. And CGT treatment will be if your sale proceed is more than 3,000 for sale of rights nil paid and is greater than 5% of the value of the shares on which the right is offered, then it is taken as part disposal. Part disposal of original shares held. Part disposal I have explained in my previous lecture, lecture number 9, how part disposal are calculated. Please go back and check it. I'm not going to repeat it here. Then it's a normal part disposal. This normal part disposal computation is done in my previous lecture, lecture number 9. Coming to sale proceed once again. If it's less than or equal to 5% or it's an or condition now. Less than or equal to 3,000, CGT will be no chargeable disposal. When we are selling at the time of the sale of the rights nil paid, no chargeable disposal. And the sale proceed in fact are deducted from the cost of the original shares. Taxpayers can elect for a part disposal if preferred. See, otherwise it's not chargeable. But there is an election that taxpayers could do. They could elect for a part disposal if preferred. Why preferred? Sometimes it will be preferable to elect. Why? Because if it's not chargeable, you cannot utilize your annual exempt amount, no? Of 6,000, it will go wasted. So if you see that it is valuable for you to elect, that means you can utilize your annual exempt amount. That means it will be less than annual exempt amount. It will fall within the, so anyway it will be tax 0%. I mean, nothing will be chargeable. So that time you can elect for the transaction to be treated as part disposal. Coming to the summary of shares and security. This the first part only I've covered. So the first part, this is not the summary of the whole lecture, summary of the first part, that is for shares and securities. Before we do question. First, exempt assets, guilds and QCBs. Only for individual, not for companies. But this lecture is for individual, okay? Valuation of quoted shares. Market value, find the average of closing and highest. Then, if it's unquoted, examiner will give you the price. Then, how do you identify the cost of the shares? If it's in the same company and same class of shares. Then, bonus issue and right issue. So, if it's in the identification rule is like this. You have to match your disposal with accusation. Number 1. First, see whether you have a same day accusation as the disposal date. Second, if no, accusation within following 30 days. This should be on a LIFO basis. And share pool. LIFO means from the last to first. We have just done a question where we did number 2 and 3. First one we didn't do. That means we did not have any accusation on the same day as disposal. And then from share pool. Just now we did a question how to work in the share pool. Next, if you have any bonus issue, right issue, add it to the share pool. Remember, bonus issue no impact on cost, right issue will have impact on cost. Bonus issue only on the shares. So that's why bonus issue at nil cost, right issue at the number and the cost. Then we have sales of rights nil paid, depend on the proceed. If the cash element is less than or equal to 5% of the value of the consideration or less than 3,000 or equal to 3,000, then it is said that sale proceed is small. No CGT disposal, but you can elect for it to be part disposal if you want to utilize your annual exempt amount. What do you do? If it's deducted, you deduct the cost. Okay. Whatever the sale proceed is received, you deduct it from the cost of the original holding in the share pool. Next, if it is not small, sale proceed is not small, that means greater than 5% of the total value of consideration and greater than 3,000, the cash element, then part disposal. And how part disposal is done? Lecture 9 I've covered. Now let us do question before we move on to the second part of this lecture. Test your understanding 3. So you have to calculate chargeable gain assuming the rights are paid for 6,000 and 1,500. So let's see. Mustafa acquired 12,000 shares on this date for 24,000. On 30th, there was a 145 right issue at 2.3. Market value of the shares after the issue was 2.65. Mustafa did not take up the issue, sold the rights nil paid on this date. He sold 10,000 shares for 37,000. So what should you do? Tell me. You have to see the condition for rights nil paid, whether the sale proceed, the and condition, whether it is more than 3,000 and greater than 5%. So if you see the consideration, in the first one it is greater than 3,000. We'll see whether it is greater than 5% also or not. For that, what do you need? You need the value of shares after the right issue. What is the value of the shares after the right issue? 2.6 per share. And how many shares you have? 12,000 shares. Do not add the right issue because we did not exercise the right issue that was given here, one for right issue. You see, Mustafa did not take up the issue, but rather he sold his right issue to someone else. So he has 12,000 shares on that date. So it's 12,000 into 2.65. What is the value? 31,800. Right? So 31,800, just take 5% of it. What is it? 1590. Yes, this 6,000 is greater than 1590 also, isn't it? So it satisfies the condition sale proceed is not small. Okay. That's why, because it is not small, it is not exempted. That means it's a part disposal. It's a part disposal. You should know how to do part disposal calculation. Okay. What is the sale proceed? 6,000. Part disposal you have to use for the cost. Okay. What is the cost? Remember, when we are doing it, we have to add the sale proceed with this 31,800. That is the value of the shares after the right issue. And what is the cost? It is 24,000. Okay. So here 24,000. The fraction is this. You have to take the sale proceed 6,000. This is the way you do part disposal. If you're not understanding why I put 6,000 in the numerator, it's A plus B into C, the cost. 24,000 is the cost. This is the calculation for part disposal. I've done it in my lecture 9. So put the sale proceed, then it is sale proceed plus the value after this thing. Right issue. Value of share after the right issue, 31,800. It's always like this. This is fixed. So the cost is 3,810. The chargeable gain is 2,190. Now, that's done. But when we are selling it, the 10,000 shares on this, the original gain we want. What is the original gain? Okay. So now we are selling it for what? 37,000, and we have sold 10,000 shares. So the original gain on that date when we are selling the share, sale proceed 37,000, allowable cost less allowable cost. How much are we disposing? 10,000 shares from 12,000 shares, because we did not exercise the right issue. Then from 24,000 we are minusing. See, 24,000 we bought it for 24,000. From there we have to minus this when we're finally disposing. What is it? This cost. Okay. Why? Because we can't take that cost. Why? That cost is for the rights nil paid, and we have already taken here from 6,000 to get the gain. Because when sales of rights nil paid is there, it's a part disposal, and that's how we got this chargeable gain. To get this chargeable gain, we needed this cost, but this cost you can't take in the actual disposal as an allowable cost in the allowable cost. That's why from the allowable cost you have to deduct it. You have to take it out. 3810, 16,825. Part disposal, you have to take it out. So this is the chargeable gain, 2175. This is the gain when we are selling the original shares, and this gain is when we are sale of rights nil paid. Please understand the difference. That is the gain on the sale of the rights nil paid, and this gain is on the sale of the shares later on. Coming to part B, when the sale proceed is 1500, it is less than 3000, but we'll see whether it's or, okay, greater than 5% or not. But since it's always anyway less than 3000 and it's an or condition, we don't have to check whether the 5% rule applies or not, because only one of the condition needs to be satisfied. So that's why what happens, there will be no gain. There will be no gain for this, but the sale proceed will be deducted from the cost of the original shares. So the sale proceed when we are selling 37,000, and what is the cost? What is the cost? We need a share pool for it. Why? See, we should know the cost of the original shares, because no gain arises in the sale of the rights nil paid. It's exempt. It's not chargeable because it's less. The sale proceed is less than 3000. So because no gain on sale proceed, but to know the gain, now we at least need to know the shares in the share pool to know the cost, because from that cost only the sale proceed will be deducted. You see, that's why we need it. So now let's do that. 12,000 we have purchased, the cost was 24,000. Then we sold the sales of rights nil paid 1,500. You see, that cost will be deducted from the cost. We told according to the rule, this sale proceed will be deducted from the cost of the original share. What is the cost? Is 24,000. That's what we did, number and cost. This is from the share pool. So here it will be 12,000. Here 22,500. Next, we sold shares. So when we sold shares, we sold 10,000 shares, and the cost was, what is the cost? You can now find out. How? 10,000 divided by 12,000 into 22,500, which is 18,750. This is the cost we have to deduct from 37,000. 18,250. This is the right answer. The capital gain when we are selling the shares. Okay. You might be asking, why didn't we do the share pool before? See, before also we did a share pool, but we didn't do that calculation. It's here. It's done here. Because nothing to be deducted from 24,000. Here we had to deduct the 1,500. The sale of rights nil paid from this 24,000. That's why we had to do the share pool. Earlier it is just 24,000 in the share pool. We could easily allocate and get the cost. Okay, in case you're not understanding, just put the share cost. It's 12,000, the number. 24,000 is the cost. Okay. And so what? 6,000. right? Can we get like that? Right? We can't get it because in the first scenario we had a profit. When we are selling the rights nil pay, there's a gain in that also. That's why. So when there's a gain on that, matter changes like this. Then you can't take share pool. Then it has to be like this. We took the sale proceed because it's a part disposal. This is a part disposal. Understand? This is not share pool, but it's a part disposal. If it's a part disposal, we don't take from share pool. Reorganization and takeover. The next section. So when there's a reorganization, it involves the exchange of existing shares in a company for another shares of another class in the same company. Takeover means when we are acquiring shares in another by issuing our own shares, by taking loan notes, or by cash. Now, our main focus is share for share exchange because here only we could, it's beneficial from the point of tax. It's good because if it's cash, we have to pay the tax. If it's share, we could delay the tax. So when the consideration for a reorganization or a takeover, reorganization means we are changing from one class of share to another class, or we are changing from debt to equity, equity to debt, like that. That is reorganization. Why do we do that? Often to, let's say the company is not performing well, often to change the performance of the company. It's a turnaround strategy which is often done. Or sometimes even if the company is doing good, maybe we want to reduce our gearing, maybe we might be having too much of debt, we might want to change it to equity now. So we keep on changing like that. Anyways, now, so whether the consideration or a takeover, if it involves issue of shares, the transaction is referred to as paper for paper transaction. There is no actual transaction that took place. I mean, cash did not take place. No, there is no change in cash. Cash is still with you. It is only on paper that now you are the shareholder of this company if you have acquired. What are the tax consequences? No capital gain tax. If it's a share for share exchange, whether it is reorganization or takeover, remember, no capital gain tax is charged at the time of reorganization or takeover. New shares acquired are treated as if they were acquired at the same time and at the same cost as the original share. The new shares stand in the shoes of the old shares now. That's why the date of purchase and the cost of original shares now will become the date of purchase and the cost of the new shares acquired. Share for share. So when the shareholder receives more than one type of share, possible, no? What happens? When they receive more than one type of share in exchange for original share, the cost of the original share is apportioned to the new share by reference to the market value of the replacement share and securities as follows. This is how you have to take the replacement value. If it's quoted share on the first day of quotation, and if it's unquoted at the time of the first disposal. Now, let's say company A is taking over company B. This conditions needs to be met. First, company A should have more than 25% of ordinary share capital in company B. Or there is a general offer to members of company B, which would give control to company A if accepted. Or company A can exercise more than 50% of voting right in B. The exchange is for bona fide commercial reason. The exchange is not a scheme for you to avoid capital gain tax or corporation tax. So, in this case, acquiring company can obtain advance clearances from HMRC. That transaction falls within this rule. That means you have satisfied this rule. You have to say this to HMRC. Now, let us do question. Test your understanding 4. So here, calculate chargeable gain or allowable loss. Okay. Melina purchased 2000 shares for 5000, underwent a reorganization, received 2A ordinary share and 1 preference share for each ordinary share. Immediately after reorganization, A ordinary share were quoted at 2, preference at 1, sold all her holding of A for 8,000. Okay. So, sale proceed is 8,000. But what about the cost? We have to do a working for it. Okay. Now, first find ordinary share, preference share. Okay. Now there are two types of share. So they told receive 2A ordinary share and 1 preference share for each ordinary share. Quoted at 2, ordinary share is quoted at 2 and preference quoted at 1. So now we'll do it. A shares, preference shares. So if it's 2000, 2 ordinary shares. So 2000 into 2 would be 4000. It is quoted at 2. So it's 8000. And for preference is 2000 because it's 1 preference share into 1, which is 2000. So total share they have received is 10,000. Now we have to find the cost attributable to A shares only. Why? Because we have sold A entirely. So it is, just find the proportion of it. Here, purchased shares for 5,000. So the cost is 5,000. Okay. Now, this is the amount of ordinary share that she has sold. Total is 10,000. So the cost is 4,000. This is what you have to deduct from the disposal proceed of 8,000 here. So the chargeable gain is 4,000. Now, interaction with business asset disposal relief. Of course, we are going to do this relief in my next lecture. Lecture 11 is all the types of reliefs available for capital gain tax purpose. There we are going to study this in detail. Okay, but for now, just know that business asset means anything which is a qualifying asset, which is a business asset. See, shares we do not use for personal reasons, right? It is always for business purpose. So when we do share for share exchange, we might get a relief. That's why we want to know how share for share exchange interacts with business asset disposal relief. And this section is new for ATX. Let's do it. Very important. This relief, make sure 101% you are going to get this relief in your ATX exam. It could come under anything from the point of inheritance tax, capital gain tax, anything. It could be any asset. So make sure that you know all the conditions, time limit for claiming BADR, whether it is eligible or not. Very important. Business asset disposal relief is one such relief which is very frequently tested compared to other reliefs. Okay. Now, business asset disposal relief will be available when we are disposing the replacement shares also in the future, provided the replacement share meets the following condition. Not the first time when you are disposing the shares now. Okay. That replacement share also when we are disposing, that time there will be business asset disposal relief. Okay. But it has to meet some conditions. Therefore, sometimes it would be beneficial not to go for business asset disposal relief. That means to disapply. But in some condition, it is beneficial. Mostly it is beneficial to go for elect for business asset disposal relief. That means you disapply the normal share for share exchange and apply for business asset disposal relief. Why? Because if you are eligible for business asset disposal relief and you disapply the normal share for share exchange, what happens? Remember, you have to disapply. It is not automatic. You have to disapply the normal rule, that is normal share for share exchange. Otherwise, you will not get this relief. Once you disapply, automatically you will get business asset disposal relief. If you get that, then any gain on disposal of the ordinary share will be charged at 10% CGT. That is the advantage of business asset disposal relief. Any gain, Eligible for BADR is eligible for 10% capital gain tax. Immediately it is chargeable to capital gain tax at 10%. And sometimes even after business asset disposal relief, you can get further advantage. Maybe that gain after deducting BADR will be less than your annual exempt amount. So it might be covered by your annual exempt amount also. Okay. Now, if you are having consideration in both cash and shares, what happens? When we are taking over, we might give them cash or shares also. Possible, no? What are the tax consequences? It depends on how small your cash element is. You have to see your cash element. If your cash element is small or not small. If it's small, definition of small is what? It is same like your sale of rights nil paid. Right? There also we saw whether the sale process is small or not. This was the condition. Less or equal to 5% of the total value of consideration or less than 3,000 or equal to 3,000. No capital gain tax when at date of takeover, but we deduct the cash received from the allowable acquisition cost of shareholding. If it's not small, there's a gain. Gain will arise only on the cash element at the date of takeover, okay? And it is treated as part disposal. Then, deemed cost of original shares apportioned to cash element. This is how you do it. Cash received divided by total consideration into cost of original shares. Now let us do questions. So we have two questions now. Illustration 2 and test understanding 5. Illustration 2, calculate chargeable gain as a result of takeover. Patrick bought 10,000 shares for 20,000 and Target PLC received on 3rd November, the entire share capital of Target PLC was acquired by bidder. Target PLC shareholder received 2 bidder shares and 0.5 cash for each share held. Bidder PLC shares were quoted at 1.25. Okay. So now first we have to find the consideration, both shares and cash. Okay. Cash is 10,000 shares into 0.5. Which is 5,000. And shares are how much? BDPLC shares were quoted at 1.25, but we have to know the number of shares. This is in Target PLC. 10,000 share is in Target PLC and BPLC. Okay, Target PLC shareholder receives 2 bidder PLC shares. Two, that means for one target, okay, they will receive 2. So if it's 10,000 target, how much they will receive in B? It's cross multiplication, 20,000. Okay, 20,000 shares. So 20,000 shares are quoted at 1.25, which would be 25,000. 30,000. Now, check the condition. More than 3,000 or not on 5%. It's an and condition, by the way. Okay, so this is 5,000. Greater than 3,000. And we'll see whether it is greater than the 5% of the total consideration. 5% of 30,000. Total consideration, okay? 5% of 30 is 1,500. So yes, you have received more than it. More than 1,500. Because you have got cash 5,000, right? Which is more than 1,500. That's why this is a part disposal. The cash is not small, it's a part disposal. So how much did you sell it off for? 5,000. It's the sale proceed. You see here? What are the disposal proceed you have to use? Disposal proceed is cash, 5,000. And then the cost. It's a part disposal. So part disposal, what is the cost? Cost is 20,000. Okay, they have given the 20,000 here already. 20,000 cost into A divided by A plus B. What is A? Cash consideration. Cash consideration is 5,000. Total consideration is 30,000. So how much is the cost? 3,333. So it is 1,667. This is the chargeable gain. And Patrick's allowable cost. This is not asked, but I'm just telling you. In future, when they are disposing the shares in bidder also, what would be the cost? In future, you have to deduct it from this cost, 20,000. Okay, from that cost 20,000, this will be deducted 1,667, the gain. Which would be 16. This is an allowable cost. This would be an allowable cost in the future when we are disposing the shares in bidder. Now, moving on to test understanding 5. Calculate capital gain tax liability. Straightaway liability, not gain and anything. Held 10,000 shares, purchased it for 15,000 and received 3 ordinary share and 1 preference share plus 1 cash also for every 1 share previously held. After takeover, shares are quoted at 3, 1.5 for preference. Victory has never worked for the company and taxable income is 60,000. 60,000 means high income earner. Why did they give you the 60,000? For you to tell you your CGT rate. Do you have any basic rate band remaining from income tax? No. Always taxable income is taxed first before gains. So CGT would be at 20%. Not 28 because no residential shares has nothing to do with residential purpose. It's always for commercial purpose. So 20%, higher rate. But if applicable for BADR, then 10%. CGT could be 10%. Now, we need 3 types. There are 3 assets: ordinary share, preference share, cash. Do not get confused. So we'll write one after the other. Ordinary share, preference share, cash. Okay. Market value and the cost. For ordinary share, what is the cost? See, first find the number of share. Okay. Market value. It is 10,000 shares. Okay. So they are saying they have received 3 ordinary share. So 3 ordinary share means there would be 30,000 shares. Ordinary share would be 30,000 because 10,000 into 3. Preference there is 1. So it's 10,000 shares. So 10,000 preference share. 10,000 into 1. And cash would be plus 1 pound. Cash for every 1 share held. So cash is also 10,000. Now we have to find the market value. It's very easy. Take the shares and multiply with the quoted. So 30,000 into 3 because ordinary shares quoted at 3. So 90,000. And preference shares quoted at 1.5. So 10,000 into 1.5, 15,000. And cash. Cash is quoted at 1 plus 1 cash for every one share. So it's 10,000. 10,000 into 1. Now we have to find the cost. Okay, for ordinary share. Now, what is the total? 115,000, isn't it? What would be the cost for ordinary share? The cost is 15,000. She bought 10,000 shares for 15,000. So this 15,000 shares would be allocated. Okay. We'll do the working somewhere else. Ordinary, preference and cash. So 15,000 is the cost. 15,000 is the cost here also. 15,000 is the cost here also. Multiply by. What is the total amount of market value for share out of the total? 90,000, no? Divide by 115, this one. For preference is 15,000 over 115. And for cash is 10,000 over 115,000. So if you do like that, you will get the cost. I will write the cost here. For ordinary share, it is 11,739. Preference 1957. Cash 1304. Total cost 15,000. You see, this 15,000 is allocated. Now, tell me what would be the chargeable gain. To know that there is chargeable gain, always whenever cash is there, cash is also there. You have to work out whether cash is small or big. That condition needs to be satisfied. Cash element, whether it's material or not. Look at the cash element. It is 10,000. If you see the market value is 10,000. 10,000. Cash is greater than 3,000. What about the 5%? It's an AND condition. So 5% rule has to be met. 115,000 consideration. Take 5%. It is 5,750. Yes, 10,000 is greater than this also. So cash is big. Cash element is big. It's a part disposal. It's a part disposal. What is the sale proceed? Only take sale proceed for cash because cash is only taxable. Only gain for tax. So 10,000. Not the entire amount. Cost for cash. Just now we got 1304. They asked for taxable gain. This is chargeable gain. 8696. This is chargeable gain. CG. Deduct annual exempt amount. 6,000. 2696. This is taxable gain, but they asked CGT. This would be taxed at 20%. And 539. Here you are not applicable for business asset disposal relief, BADR. Why? Tell me. First, she's a high rate taxpayer, that's why she'll be taxed at 20%. That is understood. But why BADR is not available? See, for BADR to be available, she has to work for the company. But Victoria never worked for the company. That's why this is not available. You understand now? Now, mixed consideration once again, but this time including QCBs. Earlier we had cash and share. Now QCB. So we can have mixture of share, cash and QCB. QCBs are company loan notes, right? CGT consequences will be on the cash element. QCBs received. So QCBs received also will come into the consideration of capital gain tax along with the cash element. Cash element part we have seen how it works. Done questions enough. Coming to QCB. So our focus from this section onwards is on QCB. So when we are taking over, the tax consequences relating to cash element of the consideration are the same as summarized in the previous section above. That means whatever is applicable for cash is applicable for QCB also. Okay. So nothing to worry about, nothing new to learn here. So that means when you are receiving QCB in exchange for shares, what happens? There will be a chargeable gain that will arise, which you have to calculate at the time of takeover. Just assume corporate bond is nothing but cash, same like cash. Gain will not be taxed at that time. Chargeable gain will arise, yes, it will not be taxed. What happens? If it's QCB, gain is frozen and it is not charged until the corporate bond itself is disposed of at a later date. Okay, this is you are rolling over the gain. Now, when you are subsequently later on, when you are disposing the corporate bond, what happens? Then no gain will arise on the bond itself because bond are exempt assets. We have studied in the first slide itself, QCBs are exempt assets. On the bond, no gain will arise. But that frozen gain, because your consideration was QCB, chargeable gain arise. We calculated, but we did not pay tax. That gain was frozen that time. Now it will be chargeable. That gain becomes chargeable now at 10 or 20%. Interaction with business asset disposal relief. Remember, if BADR is available at the time of takeover, then taxpayer can elect for this one and they can get it taxed at 10%. The gain will be taxed at 10% at that time itself. It will not be rolled over. Rather than getting it taxed later at 10 and 20%, make sure if you are eligible for BADR, elect for it and get your gain taxed at 10% at that time. This could. But if this is not claimed, BADR is not claimed, then what? Then normal way you defer the gain and at appropriate rate gain will be taxed at either 10 and 20%. Now, tax planning. Yes, individual can choose when to dispose the QCBs and they can dispose these QCBs in small amounts rather than disposing it entirely in one go. Small, it's like piecemeal basis. You can dispose. Make sure, try to defer your gain. Try the deferred gain is crystallized and matched again. Okay, individual should plan in such a way that they should ensure as far as possible the deferred gain is crystallized and matched against any unused annual exempt amount. Try to, wherever you have not used your annual exempt amount, try to increase your deferred gain in that area so that gain could be matched against your annual exempt amount. And if you have any capital losses also, make sure you defer the gain and that gain is crystallized in that tax year. No CGT arises on the disposal of QCB. Once again, I've mentioned. Now, so let the summary of the second section of this lecture, that is reorganization and takeover. Number one, it could be share for share exchange. If it's share for share exchange, no capital gain tax will arise at the time of takeover. But the cost of original share becomes the cost of new share because it's share for share. Then we have cash consideration receipt. We have to see whether it is small or not small. If cash is small, no capital gain tax. Rather, cash received is deducted from the cost of original holding. If it is not small, there will be a gain for the cash element and it is treated as part disposal. Mixed consideration. You have QCBs also. Okay. Calculate the market value of the consideration. Cost of the original share is allocated to the elements of takeover consideration in proportion to the market value. We have done question. What are the CGT consequences? If it is share, no chargeable gain. If it is cash, there will be a chargeable gain. But this again depends whether cash element is small or not. If cash element is small, no capital gain tax. If it is not small, then a gain will arise. And then QCB, treated same way like cash. Okay. So QCBs will be part disposal. And gain will arise, but you will freeze. The gain will be frozen and it will be charged later on when you are disposing the QCB. But QCB itself is exempt from CGT. Only the frozen gain becomes chargeable. Now let us do question on reorganization and takeover. Illustration 3 and test your understanding 6. So in illustration 3, we have mixed consideration. We have to calculate chargeable gain. Okay. So what is the first step that you need to do when you are given mixed consideration and you have to calculate chargeable gain? Is you have to find how much is cash, how much is shares, and how much will be loan notes. And you have to allocate the cost accordingly. Because if it's a cash, you have to pay tax. It's chargeable. And if it's shares, you can defer it. The gain is deferred. It is not taxable. And loan notes are treated in the same way as cash. So let's see. On 26th May, Kalia sold 200 £1 ordinary shares in Cafe PLC for 5,500 and all her loan notes for 9,600. Shares she only sold 200, but loan notes she sold the entire loan notes for 9,600. Then Kalia bought 1,500 shares in Joy Cafes Limited. Market value was 1215 when she started to work for the business. Joy Cafes was taken over by the Cafe PLC. Okay. For every 20 ordinary shares held, Joy would receive 100 in cash, 10 ordinary shares, and 1 loan note. Now, immediately after the takeover, the value of the shares is 12 and value of the loan note is 55. Okay. Very simple question. But if you haven't practiced enough on this area, it could be difficult because we don't know where to start. So many values are given. So let's first apportion the cost to the consideration received. We received consideration in 3 forms: cash, loan note, ordinary shares. So let's quickly apportion that first. So here purchase consideration and the cost allocation. Because if you don't find the cost, you can't deduct from the sale proceed to find chargeable gain. That's why we have to allocate the cost. Okay, so first is cash. How much is cash? Purchase consideration has been given to you. Isn't it? Where is the purchase consideration given? Sometimes purchase consideration they give you, sometimes you have to find out. Okay, so here you have to find out. How are you going to do that? Well, how many shares Kelly originally bought in Joy? 1,500. Isn't it? And they are saying for every 20 ordinary shares, she's receiving 100 in cash. For every 20. So it would be 1,500 shares they have, and for every 20, it would be 100 of cash. So it would be 7,500. Now, you have to find the cost allocation. How are you going to find the first cost allocation? You can't find the cost allocation until you don't find the total purchase consideration. So we'll leave it for time being. Then coming to shares. Okay, for shares, how many are there? It's the same. For 1,500, you are having 10. So this time it would be 1,500 divided by 10 into how much? Sorry, this is into 20. because for 20 ordinary shares into 10. But remember, immediately after the takeover, the value of the KPP shares and securities was 12. So this is into 10 ordinary shares. Then you have been given the price. 10 into 12, the total. Okay, so that's the same thing you have to write here. 1,500 for 1,500 share was purchased. For each 20, for 10 ordinary shares, the price is 12. This is how you get the purchase consideration. It would be 9,000. And then loan notes. Same, 1,500 divided by 20 multiply by, what is it? Here it is 1 pound. Okay, and the value is 55. So that's why 1 into 55, it would be 55. Now, 4125. So now we'll add all. The total is 2625. We need this to find the cost allocation. That's why I waited. So now it's very easy. Purchase consideration out of the total, this much. 7,500 divided by 2625. Multiply by, what is it? Cost allocation. You bought it for 1215. This was the cost when they started the business. So this is the cost, 1215. It is here 442. Same way we have to do for shares also. 9,000 out of 2625. Multiply by 1215. It is 530. Then same here. 4125 divided by 2625 into 1215. It would be 243. The total would be 1215. You see, this you have to get. Now if you see the cash consideration, it is 7,500, right? You have to see whether it's small or big. To know that, you have to know the rules. 7,500 is greater than 3,000. One rule is satisfied. What about the 5% rule? It has to exceed 5%. 5% of this value. So 5% of 2625 is 1031. So definitely this one exists, this one also. So therefore, the cash consideration is not small. Because it is not small, it would be part disposal, according to the rules we have studied before. So here, when we are disposing the shares for cash, okay, cash received is 7,500 and what was the cost for it? 442. We found that in that table. 7058. This is the chargeable gain. This is when we are disposing the cash. Disposal of Joy Limited shares for cash. When we are disposing the share for cash, this is the chargeable gain. When we are disposing share for share, sorry, let's start with the loan notes, because that there also there will be a gain. This is cash. For loan, disposal of Joy Cafes Limited shares for QCB for the loan note. Then what happens? Remember, it's a frozen gain. What is the value of the loan notes received? It is this. 4125. This is the value of the loan notes received, and the cost was 243. 3882. This is frozen gain. Write frozen gain. Don't write chargeable gain. And it would be taxable at the time of takeover in 1819. Will it be? No. Nothing would be taxable. When at the time of takeover, it's not taxable because it's frozen gain. So what is the total chargeable gain? Only this much. This is not taxable. Only this much. Okay. Now, coming to the disposal of 200 shares. Remember 200 shares we are disposing of. What is the proceed? This is when we are disposing the shares. But remember, we are only selling here. It's written here. We are only selling 200 shares. Okay. So when we are selling 200 shares, what is the proceed? They have given you the amount. We have sold it for 5,500, this amount. Don't go and write this amount, by the way. Don't write 9,000. That is for 200 shares. If you are selling, how much you are getting? So 5,500. What is the cost? You can't use that table because that cost is only for 200 shares. And the cost that I have done in the table before is for the entire share. So how much? You have to allocate. See, what is the total deemed cost? It is 530. This has to be allocated. Okay, how much shares you have? It's very important to know. You should know how many shares you are having at the moment and how many shares you are not having. This is very important. It's very, very important. You have 750 shares. You have 750 shares. How? Because you purchase 1,500 shares for 20. Okay. In the CAP PLC, you are having 10 shares. So it is 1,500 divided by 20 for 20. There you are getting 10 ordinary shares. So this is 750. Out of the 750, you are selling 200. At each stage, you need to know how many shares you are having. So the cost is 530 multiplied by 200. You are selling out of 750. The cost is 141. 5359. This is a chargeable gain when we are disposing the 200 CAFE PLC shares. This is now when we are disposing of the loan notes on the date. See the dates. The dates are very important. Okay. Calculate the chargeable gain arising in the tax years this and this. They have given you 2 tax years. Okay. So that's why it's very important. See, first gain you have calculated is when we are taking using cash, ordinary shares and loan notes. We found frozen gain and all those things. Now at the end, that is on 26th May 23, we are doing 2 things. We are selling 200 shares for which we just now we found a gain, and when we are selling the entire all her loan notes we are selling. So when we are selling all her loan notes on 26th May 2023 for 9,600, that time there will be a gain. That time is not frozen. Okay. That time even the frozen gain that you calculated in 1819 now becomes chargeable. Understood? So let's find the gain first for 23-24. Loan note. 26 May 2023. Okay. Remember, any gain on the disposal of the loan note is exempt from CGT. Okay. But as loan notes are QC based, what happens? That frozen gain now becomes chargeable. Frozen gain you have calculated. What was the chargeable gain? This one. This 3882 we have already calculated. That time it is not taxable, 1819, but in this tax year, when we are disposing the loan notes, entire loan notes, it becomes chargeable. So the total chargeable gain would be this 3882 plus this 5359. But the gain on the disposal of loan note, you sold it for 9600. What is the cost? It's here. This one, loan notes. 4125 consideration. 4125. This is exempt. Remember, this 5475. When we are disposing the QCB, loan note is QCB in this case. When we are disposing, this is exempt from CGT. Only that frozen gain calculated in 1819 now becomes chargeable in 23-24 tax year. Very important to write that this is exempt from CGT. You just can't ignore it like that. Otherwise, you are going to lose away some marks. So now, what about the tax rate? At the end, you have to talk about tax rates. Whether it would be taxed at 10 or 20%. Because it's not a residential property, 18-28% does not come into the picture. Now, look at it. To know the tax rate, always see whether someone is a basic rate taxpayer or a higher rate taxpayer. This is very important. Based on this also, this only you can say. But here, they have not mentioned anything. Okay? They have not mentioned anything. You don't know anything about it except the gains. So, this you leave it. Otherwise, sometimes you have to mention it, even if they don't say. If, for example, they have given you tax rate, they have seen that they have worked for the company. So, you have to see whether business asset disposal relief is available or not. But here, we don't have to do that. Now, coming to test understanding 6. Calculate chargeable gain arising in this tax year. Explain the CGT consequences if he was to sell all his loan notes in June 2025 for 32,000. Here also the term of takeover is similar. 1 ordinary share, 2 10%, 1 loan notes and 40 pence in cash. 3 things. Here she is selling 400 ordinary share for 3,600 and before the takeover Jasper owned 12,000 ordinary share which he had acquired for 15,700. Now these are the quoted prices on this date. Ordinary share 350 pence and loan note is 110 pence. Similar to the previous question. So if you had done the previous question, this would be very easy for you. We have to apportion the cost. We have to apportion the purchase consideration also, in fact. How much is for cash, shares and this one. So let's quickly do that. Okay. So now, purchase consideration cost. Shares, loan note, cash. Okay. For shares, how much would be the consideration? How many shares are there? 12,000. He owned 12,000. Unlike in the previous question, there you had to calculate. Here, straight away they have given you how many shares. So 12,000 and pound 1. So 12,000 into 350 pence. Okay. They have given you the price. 12,000 into. So it is 42,000. 42,000 is the purchase consideration. Next, to find the cost, you have to wait because we have to find the total purchase consideration. Now coming to cash. Sorry, not cash, loan note. How much is a loan note? 2. 10% one loan note. So ordinary share is 12,000. Okay. So 12,000 into 2 is 24,000. Okay. And 24,000 into what? 110 pence. So into 24,000, which is 26,400. And coming to cash. Cash is once again 40 pence in cash. So it is just 12,000 into 40 pence, which is 4,800. Add all, 73,200. And how much did you buy it for? 15,700. So that is the cost. Let's allocate 15,700 into, from the total consideration, share is 42,000. 73,200. How much is the cash? 9,008. Same way, 15,700 into 26,400 into 73,200, which is 5,662. And for cash, again it is 15,700 the cost. Purchase consideration of cash is 4,800 out of the total 73,200. Cost is 103. If you add, it has to be 15,700. This is the cost. Okay. Now we'll see cash consideration. It is 4,800 greater than 3,000. Take 5% of 73,200, which is 3,660. So this 4,800 is greater than that also. That means it's not a small, it's a big cash. Cash consideration is not small, so it's a part disposal. This is similar to the previous illustration 3. So for this part disposal, we take cash received and deduct the cost. Cash received is 4,800. What is the cost? It is 1,030. And 3,770. This is chargeable gain. Except the figures, everything else is same. Now, disposal, when we are disposing it for loan notes, QCBs. Value of the loan is 26,400 and deduct the cost 5,662. All this we have calculated above. So 2,738. This is frozen gain. At the time of takeover, it is 0. Now no tax. Same like before. At the time of takeover, not taxable, 0. Now when we are disposing the shares, what happens? We are selling it for how much? 3,600. But we have to find the cost for 400 shares. The cost for shares is 9,800. How many shares we are disposing? 400 out of 12,000. So the cost is 300. 3,300. And this one, 3,770. Both are taxable. So add together, total chargeable gain is 70. You see? So once again, we'll go here and I'll show you. We are selling 400 shares, okay, for 3,600. Now, part A is done. Calculate chargeable gain is done. Come into part B. Explain the CGT consequences. If you were to sell his all loan notes for 32,000, what happens? There would be an increase in the value of the loan note, isn't it? Here, loan note was 26,400. Now, loan note increased to 32,000. So how much it increased? It increased by 5,600. This increase is exempt from CGT. Why? Because QCBs are exempt assets. This you should know. But remember, the disposal of the loan note will crystallize the frozen. Remember the frozen gain of 2738? We have calculated here this becomes chargeable. In the tax year, which tax year? June 25. So it's 25, 26. This tax year frozen gain would be chargeable. So now we are moving on to liquidation of a company. Once a company you have decided you're going to liquidate, what happens? The liquidator, there's a liquidator who is appointed, whose role is to distribute cash or other assets to shareholders once the liabilities has been paid. These are the CGT implications. Shareholders are treated as having sold their shares for proceeds equal to the amount received on the liquidation. A chargeable gain on the disposal of shares calculated in the same way. What are the loss relief against income? Capital loss can be carried forward. Normally, capital loss are carried forward and you can relieve them against chargeable gain. But an alternative use of the capital loss can be claimed. Relief against income is available if these conditions are satisfied. Number one, the loss arises on the shares subscribed for in unquoted trading company. Remember, the loss that you're having, you normally can't relieve the capital loss against total income. But they are saying if these conditions are satisfied, you can even relieve your capital loss against income. When? When it is an unquoted trading company and conditions are satisfied. That time you can claim the loss against the income. That means you can reduce your total capital loss against total income in the tax year which the loss arose and also the tax year before, the preceding tax year. Now, loss relief against income. So therefore, the claim effectively converts a capital loss into a trading loss. That means after that it will be utilized in the same way how you utilize trading loss against total income. By the way, reliefs, set of CTG reliefs is my next lecture. Lecture number 11. Okay. As a result, higher tax saving can be achieved for the relief and the relief for the losses obtained earlier. Otherwise, you have to wait when are you going to get the chargeable gain. So rather than doing that, if you deduct against income, remember income are charged at 20, 40, 45% compared to CGT, whereas it is charged at 20 or 28%. So if you can convert the gain into income, if you can set up your capital loss against total income, it reduces your income and your income will be taxed at lower rate. That means that's why it's higher tax saving. And also if you are getting it relieved now, earlier rather than later, it's better from that point of cash flow also. Now, conditions for loss relief against income. What are the conditions? That says that capital loss you can deduct against income. Number one, loss arose from the disposal of. Remember that loss has to be from the disposal of unquoted ordinary share in an eligible trading company. Let's say enterprise investment scheme company. If it's an EIS company, it qualifies this condition. And we have studied EIS in detail in the previous lectures. Under what? Under investment income. Yes. Under my property and investment income lecture, I finished EIS, SEIS and VCT Venture Capital Trust. The share must have been subscribed for, not purchased. Second condition. Third condition. Disposal has to be at arm's length for full consideration, or it has to be occurred on the winding of the company, or it has been because the value of the shares has become negligible. Any of this condition disposal happens, you can deduct your capital gain against total income. Now let us do question. Test your understanding 7. State any reliefs Artem can claim regarding the fall in value of his shares and describe the operation of any relief which could reduce his taxable income. So he has subscribed for 5,000 shares, which is an unquoted trading company, 3 per share, received a letter informing him that the company had gone into receivership, that means liquidation. Shares are almost worthless. The receivers dealing with the company estimated that on liquidation will receive 10 pence per share. Non-savings income he has of 45,000. So tell me, what are the reliefs you could think of? This is, first understand the scenario. Don't just write all the set of reliefs that you know, against income, against total income, against gain. No, it is a liquidation, case of liquidation. So all your relief has to be based on this area. So when it's a liquidation, what happens? Shareholders are treated as having sold their shares for proceed equal to the amount received on liquidation. Okay, and a normal capital gain or loss is calculated. So when Atom will sell the shares, he's going to make a capital loss. And if you see one line where they say the shares are worthless now, there is a word for it that we studied earlier, my earlier lecture. What is it? You can claim for what? Negligible value claim. Negligible value claim. This is how from the case study you have to pick the reliefs, not what you have studied in your book. Don't just list all the types of reliefs. No. So it is negligible value claim. This they can claim. If they claim this, it will give rise to, remember the rules of negligible value claim. What happens? It will give rise to capital loss. You need to calculate that loss. How much? How much? Subscribed for 5,000, 3 per share. Okay, so it's 15,000. 5,000 into 3, 15,000 worth of shares. And he will receive how much from liquidation? What is the proceed? 10 pence per share. 10 pence means 0.01 pounds into 5,000, which means it's 500. You will receive 500 for 15,000 shares, worth of 15,000. So capital losses 500 minus 15,000. He's going to receive 500 for the 15,000 worth of shares. 14,500 is the capital loss. What happens? See, always write the facts. Because this capital loss arised when we are disposing unquoted trading company and we have subscribed, not purchased the shares. Okay, you can get this relief against total income. This 14,500 capital loss can be relieved against total income, either in the previous tax year or in the tax year when the loss arose. Okay, so let's say against the current income, current year's income, we are getting the loss relieved. So this is the total income, 45,000 from non-savings. Let's say. Now, so this claim will reduce his taxable income, 45,000. So from 45,000, we deduct 14,500 capital loss. It will bring your loss income to 30,500. So because 30,000 income falls to 30,500, earlier he was a higher rate taxpayer being paid at 40%. Now he'll be paid at 20%, saving 20% tax because he falls in the basic rate taxpayer. Okay. The last part of this lecture, stamp duty and stamp duty reserve tax. So we have finished the shares and the security part. Now we are moving on to stamp duty. And stamp duty is very easy, very small. Similar to stamp duty, land tax. The only thing is rates and the disposal on which it is taxed are different. But the principle is same. Now, so stamp duty land tax was covered in lecture 10. This section covers only stamp duty. And stamp duty is payable when we are transferring shares or other marketable securities, unless the transfer itself is exempt. Stamp duty is payable by the purchaser on the transfer of shares and securities, and not on a newly issued shares. It is based on consideration that is payable for shares, and it might not be the market value of the shares. And the rate is 0.5%. Okay, this rate is different to stamp duty land tax. Stamp duty land tax we have 0, 2 and 5% based on the band in which it falls. If you can recall stamp duty land tax, first 150,000 0%, 150 to 252%, and more than 250,000 was 5%. But here it is charged at 0.5% for the consideration that is payable for shares. It is rounded up to the nearest 5 pounds. And on the date of transfer document, it will be levied. There is no charge if the consideration is 1,000 or less. Now, when the shares are transferred without a written document, that means we are transferring the shares electronically. So rather than stamp duty reserve tax applies, SDRT. And this is normally same, 0.5% on consideration, but this is rounded to the nearest pence. Okay, and rest everything is same. Now these are some exemptions from stamp duty. You have to know, otherwise you will include it in the stamp duty. There are some transactions, some type of transfer which are exempt from stamp duty. Maybe it is the type of transfer that is exempt or the type of security that is exempt. So exempt transfers, these are the exempt transfer when we are gifting to someone where no consideration is given, giving something for free, exempt. Divorce arrangements, anything because of divorce arrangements is transferring among the two parties, exempt. Variation of a will, exempt. Change in composition of trustees, exempt. Takeovers and reconstructions where new shareholders mirror the old shareholding, exempt. Transfer between 75% group companies, exempt. By the way, group companies we are going to study when we go to companies, corporation tax. Now, investment transfers, exempt. These are the exempt securities. Government stocks, exempt. Most company loan stock, exempt. But if it's convertible loan stock, not exempt. Unit trust, exempt. Shares quoted on growth market, like AMI shares, exempt. Remember, to qualify for exemption, the transfer document have to state which exemption is being claimed. Is it a security it is exempt or the transfer is exempt? Now, most company loan stock is exempt from stamp duty, provided you cannot convert it into shares or other security. It does not carry an interest more than the commercial rate, or the rate is linked to the company results. It does not carry the right to the repayment of more than the nominal amount of capital. So this is the summary of stamp duty and stamp duty reserve tax. Stamp duty payable by purchaser on transfer of shares, 0.5% of consideration, round to nearest 5 pounds, no charge if consideration 1,000 or less than that, and levied on the date of transfer. Stamp duty reserve tax, this is also payable by purchaser when you are transferring. It's an electronic transfer of shares, 0.5% rounded to nearest pence and leave it on the date of agreement. Exemptions. Exempt transfers. Gives, divorce arrangements, variation of will, takeovers, reconstruction, transfer between 75% companies. Exempt securities. Government stocks. Most company loan stocks except if it's convertible. Then it's not exempt. Unit trust and AMI shares. Now let us do question before we conclude this lecture. Illustration 4 and test your understanding 8. Here we have 5 transactions. We have to show how much stamp duty is payable. First one, 5,000 shares in a quoted company for 10,000. So it would be simply 10,000 into 0.5%, which is 50. Next, 8,000 8% convertible loan stock of a quoted company for 12,000. 12,000 into 0.5%, which is 60. 10,000 5% treasury stock for 9,000. Remember, this is treasury stock. It is exempt. It's nil. There is no stamp duty on purchase of government securities. It's a government security and it is exempt. 5,000 units in Grow Big Unit Trust. 6,250. Nil. This is also exempt. Next. 10,000 £1 ordinary shares in unquoted company for 75,000. Share had a market value of 250,000. Remember, market value is not relevant. So it is on 75,000. We have to pay 0.5%, which is 375. Now moving on to test understanding 8. Same. 3 transactions are given. Calculate stamp duty. First one, 5,000 shares in Summit Limited for 10 to 30. Okay. So 10 to 30, it is multiply by 0.5%. Remember to round to the nearest 5 pounds. It is 51.15 pounds. 51.15, but you can't keep it like that. You have to round it up to the nearest 5 pounds. So it is 55. Answer is 55. If you round it up to the nearest 5 pounds. Next, whole of the issue share capital 125,000 plus an additional payment of 35,000 if company's profit is more than 80,000. So here you have to add 125 plus 35. So B 125,000 plus 35,000 multiply by 0.5%. It is 800. And C 10,000 5% treasury stock exempt. Treasury stock is exempt, so nil. Okay, you have to write it's exempt. So add 55 with this. It's 855. The total stamp duty payable. Now, so let's summarize this lecture. Shares and securities. We started with exempt assets. Then basic CGT rules, valuation rules, if it's quoted, unquoted, unit trust, identification rules, the 3 rules, that is same day as the day of disposal when we acquire shares, then the following 30 days, and then from the share pool. Then we have bonus issue, right issue. We have to see the impact under both the new shares acquired and the cost, as well as sales of rights nil paid. Okay. Then share reorganization and takeover, share for share exchange, mixed consideration where we have cash, shares and QCB, and stamp duty, as well as stamp duty reserve tax. So that's it for this lecture. Thank you for watching, and I shall see you in the next lecture, that is lecture 11. That's the last lecture under capital gain tax, where I'm going to cover all the CGT reliefs for individuals. After that, lecture 12 onwards, it will be new type of tax, that is inheritance tax. So make sure that you watch all my previous lectures. If you have missed out on any, do not forget to subscribe to my channel and share my content with your friends as soon as possible. Best of luck for your exam and thank you for watching.